You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. And today, the product that started us all down this road, Current Assumption Universal Life with Bobby Samuelson.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, your host, and with us today, of course, is Bobby Samuelson, who's been with us Monday, Tuesday, and now Wednesday, and all this week about life insurance. We're cherry-picking every mortality chassis we can think of, and while we're doing it in front of a live audience. We're broadcasting out of Fountain Hills, Arizona, home of the largest fountain, and everybody always asks me, Steve, is that a real green screen or is that the real fountain? That is the real fountain.
It is.
And remember, our national broadcast now, somewhere around 230,000 agents can get a live feed on this. Hey, if you want that live feed, just write us at the Biz and we'll put you on our feed. Happy to make sure that you get it. Of course, we're all over the internet. And we're talking with Bobby today. And the reason we're talking with you, Bobby, is because you're a nationally recognized life insurance expert. You go all over in the institutional market with carriers, but really outside, you're with fiduciaries now. You're playing in the what I call the evil empire. You're on the security side of this issue.
Yeah.
You know, I mean, there's all kinds of. We're talking about current company assumption. I mean, I came into this game 30 years ago. Whole life, ART, that was it.
Right.
Then somebody from EF Hunt, invented this thing called buy term and invest the difference inside a UL platform when double-digit interest rates, and I'm talking those numbers were whoppers. Now, of course, what we forget is that the expense loads on those policies back in the day,
huge, I'm sure, probably
ate half of the 10 to 11% we were showing on proposals.
Right.
It was like 600 basis points charge that was eroding everything. So it was probably not as great as grandeur as we thought. But originally, when we came out, this platform, this chassis, which now has birthed several chassis, this chassis really became a kind of a boilerplate, an answer to participating whole life. Let's talk about a little bit, I'll give you a little history. Let's talk a little bit about, is that good or bad? I guess it's great in a high interest rate market. It's not that great now.
Well, so I think good or bad would probably be oversimplifying. I think there's a really beautiful story to current assumption UL, which is that, whereas whole kind of, people say it's always a black box, to use the cliche, right? You can't really see how all the pieces interact. The very cool, beautiful part about current assumption UL is that you can print off a policy charge report, and you can see your policy charges, and you can see your interest credits, and anybody with an Excel spreadsheet can recreate the product. And I do this personally, as I recreate current assumption products inside of my own spreadsheet. So what I think is actually great about current assumption was not the high interest rates or whatever else, because that was a whole separate issue. It's really just giving a product that's a little easier to understand, a little easier to track, a little easier to see all the components working together. And that's why it's really, like you said, it's a chassis that has birthed other chassis, because the idea behind it, again, explicit policy charges and explicit interest credits versus a dividend whole life contract where everything's kind of slammed in together, is an attractive story for policyholders.
Well, not only is it attractive, I mean, a lot of people sold this for income scenarios as well as indemnification scenarios, and some carriers have actually introduced liquidity riders onto this platform to juice it up during the low interest rate market. I mean, I've noticed that current assumption, I mean, you think about it birthed guaranteed UL, it birthed index UL, it birthed variable. Right. So the platform must have some good purpose to it, otherwise they wouldn't keep building off it.
Oh yeah, it's an incredibly flexible platform. Okay, and I mean, think about it, even, there's an infinite number of ways you can credit interest to these policies. VUL is one way, current assumption UL is another way, index UL is another way, no lapse guarantee even is another way. And then your policy charges, you can get very creative on how you structure the contract. So like you were talking about, the indemnification or the death benefit sale versus the accumulation sale. Current assumption allows carriers to really fine tune the product structure to do a specific thing very well. So if you think about whole life as kind of like a sledgehammer, sledgehammers are great for a lot of things, but sometimes you need a surgeon's scalpel, right? And what current assumption products allow carriers to do is really create surgeon scalpel products where they just do a fantastic job of building the structure to do exactly what they think the clients are going to want to do with them. And so there's a ton of merit to the UL chassis. Again, everybody looks back to the 80s and say, well, current assumption UL is no good because it didn't perform well. Well, the problem wasn't the product. Right. The problem was the 12% interest rate assumption, which made the mortality charges higher because they could hide it under a 12% interest rate assumption. Now we have low interest rates. These are great products. There's nothing wrong with the current assumption.
Well, I love the first point you brought up, full disclosure.
Yeah.
When you look at it, I can print out at the back of any of our proposals today all the expense loads. I see all the moving parts. I know I have to pay my expense loads out first, credit whatever interest rate I have next. Right. There becomes my net number. That's pretty easy to explain to a client. And I also like the fact that you just said, and we'll talk about this tomorrow with indexing and Friday's show on VUL, variable, because these are examples of different ways to invest on the same chassis.
Yep.
And so it really has, it's hybrid, it can be hybrid, but it also has its basic premise. Now, current assumption right now, and we still have carriers that are very much committed to the current assumption UL market because they see this as still the way to play. And they don't have the shadow accounts that we talked about yesterday. I mean, these are not the secondary guarantees.
They're very simple.
They're pretty straight up. And the difference, I've noticed that the competing carriers, the difference between current company assumption and the contractual guarantees, that window is getting really tight.
Right.
So talk a little bit about how do you see this product going forward? I mean, let's pretend not the best scenario, which is interest rates going up, but it's pretty flat or a little bit of an increase.
Yeah, so one of the things that's challenging about current assumption UL is you can look at a crediting rate, all right, and you see the performance in the crediting rate, it's 4% or whatever, and you look at low interest rates and you say, okay, there's a real problem here because I got current assumption rates at 4%, I got low interest rates at 3%, our current assumption rate's going to go down. Is this going to be a problem for my policy? You know, the reality is if you're using it for an accumulation sale, then you need to be worried about that. If you're not using it for an accumulation sale, you're using it for a death benefit sale, which is the example you just gave where, you know, guaranteed products versus current assumption UL. The crediting rate is really not that big of a deal because the policy charges are really what's driving long-term performance. So what I'd actually encourage producers to do is don't think about current assumption UL for the crediting rate, think about it for the policy charge structure. And so run your premiums, you know, showing guaranteed minimum interest credits and see what kind of premiums you come up with. And that's going to tell you whether or not it's a good risk proposition for your clients. And if interest rates go up, by the way, crediting rate's going to go up. It's going to help you some, but not as much as you think.
Well, there I go. I'm now doing 2 illustrations for my current assumption UL. Well, no problem. Listen, you can ask us about this. Just write us at thebiz@brokersalliance.com, or if you want to call us, call toll free at 1-800-290-7226. And of course, you can always hop out to our website, www.brokersalliance.com. When we come back, we're going to talk more about current assumption with Bobby.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Helping people with their finances is a great responsibility. Taking care of the families you serve requires more than just providing protection. It means helping them take smart steps towards building a successful future. A good first step is offering the Ultra Index, a low-cost life insurance product that accumulates cash values your clients can access for emergencies, college tuition, or additional retirement income. That's the Ultra Index from Lincoln Benefit Life, an Allstate company.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant, your host, and of course we're with nationally recognized life insurance expert Bobby Samuelson. And we're talking about actually the chassis that started it all in Universal Life land, current assumption UL. And we've been talking about it in light of not only the interest rates, but also this issue of expense load. And one thing we really like about it, as in contrast to whole life, is there's full disclosure.
Right.
We know the current company practice, we know the contractual guarantees, we see all the expenses, we can print this out in a proposal now, and really, we've really demystified where all the money's going and where the expense charges. But one thing I know that you're kind of fond of saying is this issue of I'm not really selling interest rates with a current assumption or the index with an IUL or the variable access to equities. I'm really selling a chassis and its expense loads. I know that's an oversimplification, but at the same time, really, we need to look at that first of all because performance is going to be completely separate from what we're talking about now.
Yeah, that's a great point. And I think when you look at innovation in the current assumption side of the world, where the innovation's coming is on the policy charge side of the house. So John Hancock has a very creative way of building a current assumption product that does a lot of great things for the client, but is really a lot of innovation get on the charge side of the house, in my opinion.
I'm charging them for that too, by the way.
You know, and there's a lot of risk in that. There's also potentially a lot of return too. So where I see carriers going with this product is they too are not focusing as much on the interest crediting side, because what's the difference in the long run between a 5% crediting rate and a 4% crediting rate? I mean, the reality is for policy performance, really not much. What you really got to do is make sure that the policy charges create product performance that matches up with the way the client's going to use it. And again, I think that is really the story here. Is it's not, don't say, well, we should be diversifying your portfolio, so we should sell current assumptions. Say, what kind of current assumption we're going to sell. We're going to sell accumulation current assumption, or death benefit current assumption, or all-in-one current assumption. And the way you find out what kind of product you have is just run some benchmarks, right? And there are carriers out there that are designed specifically for low premium, and they have a little bit lower cash value than some of their accumulation counterparts. And there are products out there that are specifically designed to stuff cash in them. And if you try and run low premium solves, you're going to end up with much higher premium numbers than you'd get on a no lapse guarantee, and it wouldn't be a good deal for the client. So it's really just, it's making sure that the pricing for the product is appropriate for the sale, and carriers are getting much, much better at building products for specific types of sales strategies.
Well, when I'm looking at current assumption UL, and I'm looking at it as an indemnification scenario, let's just go there for a moment. Because I think right now indexed is just killing it on the income side of that equation. We'll talk more about that tomorrow.
Yep.
But from a death benefit point of view, and if I ran whatever I think is going to be the prevailing rate, let's say 1%, let's go 100 basis points below current assumption today.
So 3.5.
Is that going to be legit in the long run, or am I sitting there going, should I start sweating bullets? Because if the rates hit the guarantees, there's not room to play on the interest rate. Then I got to worry about my cost of insurance picking up the profitability for the carrier. Is that going to happen?
Great question. Okay, so two issues here. One is how sensitive are these products to interest rates, regardless of policy charges? So let's say that interest rates drop 100 basis points or 200 basis points or whatever. First of all, you can see all this in the illustration, right? All you have to do is run a new illustration and see what happens. And typically, what you find is that these products are not as sensitive as you think to interest rates. Now the premium may go up 10 or 12% per 1 percentage point drop. So interest rates drop 1%, your premium goes up 10%, your premium projection should go up 10%. But if you look at the internal rate of return on the death benefit, it's not going to drop by 100 basis points. Okay, so basically what I'm saying is interest rates can move whatever direction they want, but if you look at the IRRs down the road, the difference in the IRR as the interest rate moves is not going to be as dramatic as the interest rate. So interest rates might change 100% or 100 basis points, and your IRR on the policy might only change 30 or 20. With a brand new premium that's 10 or 12% higher, this is time value of money. So the real issue is, okay, well that means that there's not as much risk to the policyholder as you might think. That's good. But that also means that the carrier is retaining more risk. Because if interest rates drop to 1 or 0 or they have adverse mortality, they got to be able to push that back.
Well, let me stop you there though, because I keep hearing about how they price for adverse mortality. We're living in the greatest mortality revolution era of all time.
Right.
Death claims are down. I keep hearing about this. They have to park money for these eventual obligations.
Right.
But we've changed our CSO 3 times. People have actually replaced their product.
Yeah.
Is that, I mean, I know it's a possibility, but is it a pragmatic possibility?
You mean to basically say to your client, hey, look, we're going to show you 95 as your LE, but the reality is it might be 105, and here's how you build a product for that?
I think you have to build it out loud. Well, by the way, let's just talk about that, because we didn't touch on that yesterday. GUL, I mean, I see guys doing duration dial a death benefit. I mean,
not okay with
and that's scary.
I'm not okay with that. I mean, because of all the things you said. I mean, I really think we ought to be thinking about these products as really long-term, 100-year products or whatever. I think maybe a broader point is that one of the problems with no lapse guarantee is, let's say that the CSO tables do get better and mortality improves, and your individual client's still in good health. You can't go 1035 in a lapse guarantee policy because there's no cash value. Right. But on a current assumption product, you can. So there is a lot of flexibility here where even if you don't like the product, if the client lives to 105, you recognize that if your client's living to 105 and other clients are living to 105, you can 1035 exchange this current assumption policy and go get something else.
Hopefully the service will be okay with like-to-like 1035 exchange.
Yeah. So that's kind of where that's probably where the issue is you've got to think about current assumption UL as a means to flexibility more than necessarily a long-term. It kind of does both at the same time, and that's why I like it. So that's a broad part of the issue. You've got to tune it up to what the mortality.
Well, I've seen more carriers come to the table on current assumption right now. It's kind of a revival, so to speak, on this product. Some are adding those liquidity riders to kind of spike the cash value a little bit. And so if you did have buyer's remorse, 15, 20 years out, you're going to get all the money you put into this. You basically rented your coverage.
Right.
I mean, when you think about that. When we come back tomorrow, we're going to be talking about indexed UL, and that's where the fireworks are going to start, although yesterday's show was pretty firework to me, I have to say. You're listening to Bobby Samuelson, one of the authorities in the United States on life insurance, and we've been talking about life insurance all this week today, current assumption UL. That's the Buzz on the Biz for today. I'm Steve Savant. Thanks for listening to the Business Insurance Zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.